Welcome back, international economists. Today we're going to be covering Chapter 10. This is the balance of payments. So basically, when trade occurs between the US and other nations, many financial transactions are recorded in a summary, and this summary is basically called the balance of payments. So this chapter we're going to cover not every single concept covered in the chapter, but the most important ones you're going to need to know for the final, as well as future assignments. So the outline, we're going to talk about double entry accounting. We'll talk about the balance payment structure, U.S. balance of payments specifically, and then we'll talk about the current account. We'll briefly talk about currency and also the balance of international indebtedness. All right, so the balance of payments is a record of economic transactions between residents of one country and the rest of the world. So records are usually kept annually and quarterly by a lot of these nations. So the United States, we keep it quarterly as well as yearly. And an international transaction is an exchange of goods and services or asset between residents of one country and those of another. So residents in this case include businesses, individuals, government agencies that make the country in question their legal trading partner. All right, so the first concept we're going to talk about is double entry accounting. So basically, this is arranging international transactions into a balance of payments. So we're going to look at credits and debits. So it's very similar to accounting if you've taken it before. So a credit transaction is a result in a receipt of payment from foreigners, and this is recorded as a plus or a positive value. A debit transaction is one that leads to a payment to foreigners. So one's a payment from, debit is a payment to, and this is recorded with a negative sign. So we're going to go over a couple examples of each. So we'll talk about examples of credits first. So anytime you see any of these, you should know that they're credits. So merchandise exports, transportation and travel receipts, income received from investments abroad. So if you invest into a country abroad and you get some form of payment in return, gifts received from foreign residents, aid received from foreign governments, and investments in U.S. by overseas residents. So those are all examples of credits. Examples of debits, for example, are merchandise imports, transportation and travel expenditures, income paid on the investment of foreigners, gifts to foreign residents, aid given by the U.S. government, overseas investment by the U.S. Residents. So basically stuff that's leaving this country, we're paying for these products, or any time of payment is involved to other individuals outside of our country. That's the key distinction. So each credit entry is balanced by a debit entry and vice versa. So if you can picture a balance of payment, you'll have credits on the left, debits on the right. Again, very similar to accounting. So the whole goal is to balance these payments, and that's not always the case, but for our examples, we'll talk about example 1 and 2. So we're going to go with example 1 first. We're going to say IBM, their firm, they sell $25 million worth of computers to a German importer. So the first thing we're going to do, because the export involves a transfer of U.S. assets abroad for which a payment is to be received, it is entered in the U.S. balance of payments as a credit transaction. So again, we're exporting this product to a different country. It's going to be a credit. So it's a positive value of 25. And then the short-term financial movement, this is going to be a debit. So IBM's receipt of payment held in the German bank is classified as a short-term financial movement because the financial claims of the U.S. against the Germans bank has increased. So in this case, the credits is 25, the debits is 25, and if you were to add these together, you would have 0. So this structure or balance of payments has been balanced. A positive 25 and negative 25 equals 0. Our second example is we're going to talk about a U.S. resident who owns bonds issued by a Japanese company, and you receive an interest payment of $10,000. So this is income coming back into the United States, so it's going to be a credit. Again, if we go back to our slide of what counts as a debit and a credit, we see our third bullet point, income received from investments abroad. So income receipts is $10,000. And then there is going to be an amount owed. So the amount owed would be $10,000 from this Japanese firm. And as these balance out, a positive 10,000 and a negative 10,000, it's going to equal 0. So we have balanced this, this payment structure. All right, so even though the entire balance of payments must numerically balance by definition, it does not necessarily follow that any single subaccount or subaccounts of statement must balance. So we'll talk about the other accounts. We'll look at, so when we talk about trade balance, we'll talk about the current account, merchandise, trade balance, goods and service balance. There's a couple other things we'll talk about. All right, so the first thing we're talking about is the current account. This is the balance of payments, and this refers to the monetary value of international flows associated with transaction of goods, services, income flows, and unilateral transfers. And we'll talk about each one of these in a little bit of detail. So the first one is going to be merchandise trade balance. This includes all goods U.S. exports or imports. So exports minus imports give us the merchandise trade balance. So when the balance overall is negative, we have a trade deficit. When the balance is positive, we have a trade surplus. So if we export more, it's a trade surplus. If we export less, import more, there's a trade deficit. So this is something that we talk about a lot in today's time. Trump has talked about this in the trade war and other transactions with other countries. All right, so to calculate the goods and service balance, so before we were just looking at merchandise. Now when we take into account, so to get basically a broader understanding of international transactions of a country, we add services to the merchandise. So now we're looking at physical goods and also services. So when balance is positive, or when this good and service balance is positive, there's a surplus of goods and service transactions. Basically meaning they're taking in, or they're providing more services and goods compared to bringing in a time period. And then when the balance is negative, we're taking in more stuff, more goods and services from an external country or a country on the outside, compared to us providing them with goods and services. So goods and service balance is a part of the nation's gross domestic product. So again, when you think of net exports, this is encompassing all of that. It's a good way to remember it. Okay, so now we have this very interesting balance of payment structure. So it is a little confusing. We're going to walk through it. So we're assuming that you as an individual want to buy a TV that's produced in Korea. So initially, you're going to say that you write a check for $300 that the U.S. bank would convert to 210,000 won. So that's won is their currency. You're going to write a $300 check. Now it's going to go through your bank. So one of the key assumptions we're making in this picture is the U.S. bank is taking care of all transactions, or the banking system is taking care of all transactions, which is not always the case. This is just to simplify the model. So $300 equals 210,000 won, and we're assuming we have a certain exchange rate. When the South Korean producer receives your payment in won, they deposit funds in their bank. So if we were to go, so the U.S. bank, you have $300. Now those $300 are converted to 210,000 won. Now they deposit that $210,000 or 200,000 won into their account. Now you get the TV. The U.S. importer gets the TV. So it goes like this. One, and these both happen simultaneously. So you deposit the money back into your account as a Korean, and you ship that TV to a U.S. importer, and the bank, again, is taking that money. Now, again, you see why this is an oversimplification, because the bank isn't doing all these transactions. So the Bank of South Korea holds a check from the U.S. that promises to pay a stipulated amount of won. So again, that's why it's given to this bank. So you start as a U.S. bank, you're sending it to the U.S. or the Korean exporter in their currency. They deposit that money into their account, and they send that TV to the U.S. importer, and we go from there. So from there, now we're going to assume at the same time you paid for the TV. A buyer in South Korea paid a U.S. producer for pay the U.S. producer $300 for some type of machinery. So now we're going to look at the other side. So now you're going to start as a Korean individual. So let me just change the color. So now you're starting from here. You send a check for $300 for machinery to the U.S. exporter. The U.S. exporter deposits money into their bank. And at the same time, they also send this machinery to the Korean importer, and that money goes back into the bank. So now it would be 1, 2, 2. So this is just looking at international payment process. So in theory, importers in a country pay the exporters in that same country in the national currency. And also, obviously, in reality, importers and exporters in a given country do not directly deal with one another to facilitate payments. Banks carry out these transactions. So again, there are a couple of assumptions being made here, but the main gist here is when you write the check, it goes to the exporter deposits into their national bank, and from there they export the product to you. And we'll see how this impacts the balance of payments. So the next one is capital and financial account. So this is transactions that include all international purchases of sales and assets, including private sector and central bank transactions. So their assets that are broadly defined include the titles to real estate, corporate stocks and bonds, government securities, and ordinary commercial bank deposits. So major types of capital transfers are debt forgiveness and migrant goods, and financial assets accompanying them as they leave or enter the country. So acquisitions and disposal of non-financial assets include sale or purchase of rights to natural resources, patents, copyrights, and trademarks. So again, it's just another account taking into account capital and financial assets. Okay. The next one we're going to talk about is going to be the private sector financial transactions. So a majority of the transactions that take place in the capital and financial account come from private financial transactions. So this is a key component of capital and financial account. We have 3 that we focus on. We have direct investment, securities, and bank claims and liabilities. So direct investments they occur when a resident of one country acquires controlling interest. Now, the stock ownership has to be of 10% or more. That's one of the key requirements. And this has to be in a business of another country. So if you invest in a country such as Mexico, you have to own 10% of their stock. Securities, this is a private sector purchase of debt issued by government and private companies. So you can purchase debt from other countries, and they promise to pay you back in a certain amount of time. Now, securities could be in the form of treasury bills, treasury notes, treasury bonds, and then also securities of private enterprises. Now, bank claims and liabilities. So these consist of loans, overseas deposits, acceptances, foreign commercial paper, claims on affiliated banks abroad, foreign government obligations. Bank liabilities include demand deposits, and now. So now stands for negotiable order of withdrawal and certificate of deposit. So those are some of the key things that they take into account. Now, capital and financial transactions are recorded in the balance of payments by applying your credit to capital and financial inflows and a negative sign for debits to capital outflows. So if money is coming in, positive, money's going out, negative. Pretty straightforward. So for example, let's just go over a little example. For the United States, a financial inflow might occur under following circumstances. So if a French resident purchases securities of IBM, so if someone from France decides to buy some debt from, or to hold some of the debt from IBM, that would count as a financial inflow. Again, they're holding some of this debt. Another one would be, let's just say a bank receives a repayment on a loan it made to a company in a different country. That's an example. And then also we have, let's say for example, Toyota builds an auto assembly plant in the United States. That's another example. This would be a capital inflow. Now the opposite would be if a U.S. resident would hold debt for a foreign country. So let's just say a U.S. resident holds debt for France. That would be a financial outflow. Again, they're sending money to these um, countries or firms outside of the country. Now let's say a bank in the United States receives a repayment on loan for a outside country. That would also be a financial outflow. So when you think of inflow, it can be linked to an export of a good and service, and a financial inflow or a financial outflow would be an import of a good or service. That's another easy way to see it. So again, if you have a financial inflow, you treat it like an export of goods and services. If you see a financial outflow, it would be an import of the good or service. Okay. So official settlement transactions. This is a movement of financial assets among official holders, such as the Federal Reserve or the Bank of England. So they have different assets available and liabilities to foreign official agencies. So these are just definition based. Okay, so official holdings of reserves used for two purposes. So they hold this to provide a country sufficient international liquidity to finance short-run trade deficits or if currency rises. So we'll talk more about currency in the next chapter. And then central banks sometimes buy or sell official reserve assets in the private sector to stabilize currency exchange rates. So sometimes when you have quantitative easing, when basically the central bank is purchasing back securities, it's going to have an influence on currency. And we've talked about currency already. If you devalue your currency, one of the unintended consequences of devaluing your currency, you're going to see an increase in trade. More people are going to want to purchase your products. Your exports are going to increase, but import decreases because it's more expensive for you to purchase, and then vice versa. So official reserve assets, some examples of this would be stock of gold reserves held by the U.S. government. We have convertible currencies such as the yen, readily acceptable as payment in international transactions, and then reserves position of the U.S. and International Monetary Fund. So here we have a graph of selected foreign holders of U.S. securities as of 2016. So these are countries that hold United States debt as of 2016. Again, there are more updated numbers. So Japan holds the most of our debt at 11.4%. So it's an extremely high number. They're at 1. And then we have China. And then from there, we have other countries that hold our debt as well. So there are sometimes statistical discrepancies, basically errors or omissions. So the data collection process of balance of payments figures is imperfect. So there's basically statisticians base figures partly on information collected and partly on estimates. So they're not always 100% accurate. So when statisticians sum credits and debits, they rarely match. So because of this, they find the residual or whatever's left over and insert it back into the equation or to the balance, and from there they make it equal. So basically you're using the residual, so whatever's left over, so actual minus predicted, and you add that back to your sum. Now this correcting entry is a statistical discrepancy or an error or omission. All right, so the U.S. balance of payments is commonly referred to as the trade balance. So in 2016, U.S. had a merchandise trade deficit of over $750 billion. Now this is basically the difference between exports and imports. So again, this is something President Trump talked a lot about in his campaign in 2016, or when he was running for presidency, talking about the trade deficit. We owe too much to China. We're too reliant on China. Talking about ridding ourselves from this trade, being able to get the better end of the stick. Now, a trade deficit is not popular with U.S. residents and policymakers, and we'll talk about that in a second. So the actual numbers for the merchandise exports was roughly, we had a positive value for merchandise and exports, but we had a negative value for imports, meaning we're importing much more, and it was close to well over $1 billion. Sorry. So again, we were exporting much less than we were importing, causing this trade deficit. The United States is a net importer of merchandise during 2016, so we import much more. The next table that we'll look at is going to show balance of payments from 1980 to 2016 in billions of dollars. So we'll look at that in a second. Now, it's not popular with domestic residents and policymakers because they tend to exert adverse consequences on the home nation terms of trade and employment levels. So basically, if we're importing much more from other countries, some people are against this because it's killing off jobs here in the United States. Again, we've talked about this before. It's not always the case that we're increasing our unemployment because of this, because those individuals can also find jobs that are created by this a main exporting industry in the United States. So that's another thing you can look at. So economists concerned over the persistent trade deficits have often focused their possible effects on the terms of trade. So again, if we look at comparative advantage, this could have an impact if we're too reliant on other countries, and also looking at our currency. This will have an impact on our currency as well. You don't want to devalue your currency. You don't want to inflate your currency either. There's a happy medium between the two. So here we have our table, and you see the last time we had a positive current account balance was in 1980. Ever since, it's been increasing drastically, and then 2004 we reached our peak, and then you see a decrease. In terms of our trade balance, we've seen a huge increase, and then again we're starting to see a decrease, but this is not implying that trade is bad or good. This is just showing us that we import much more than we export, basically. Now we have a couple other accounts here as well. We have the goods and service balance, where we include goods and services. And here we have our service balance. And then we also have our income, receipts, and payments balance, which we won't really talk about too much. Okay, so taken as a whole, the U.S. international transactions always balance. So any force causing an increase or decrease in the balance of payments account leads to exactly offsetting changes in the balance of the other account. So in our table, we had a deficit of $481 billion in 2016. This was offsetting this deficit was a combined surplus of $481 billion in remaining capital and financial accounts. So we still hold debt for other countries. There are other countries that owe us as well, and this number also includes our statistical discrepancy, basically when we add our residual to balance everything out. So there's still some might say this isn't an accurate measure or a good thing to do, but at the end of the day, this is the way that we conduct our balance of payments. It's hard to get completely accurate numbers. Again, they use estimates, and they use this method to balance the sheets. Now we'll also talk about net foreign investment. So before we talk more about current account, I just want to back up. So here, when we talk about our current account balance, yes, it's negative. That is showing us that we have a huge trade deficit. We're importing much more than we're exporting, but it doesn't take into account our capital and financial accounts. So let's just say a foreigner buys, or foreign countries buy much more of our land, capital. They buy more buildings and bonds, this is going to have an impact on our current account as well. So this is why 481.2 is generated, because we're taking into account our financial accounts. So other countries hold our securities as well. This is going to be an inflow, and this offsets our deficit. So we can afford to import this much because we have a huge capital and financial account. Countries buy our products, they buy our land, they buy our bonds. Again, we are a safe bet if you look at it in terms of a market. We have a safe economy. We've always shown growth. Obviously, right now everyone is on a downward spiral, but for the most part, the United States has always been a safe bet. So this is why we are heavily invested into. So that's why we can afford to import as much as we do. Okay, so the net foreign investment, this is basically a current account balance. This is synonymous with the net foreign investment in national income accounting. So basically this formula, give me one sec. I'm sorry. So the formula on the bottom of the slide is basically showing you what national income accounting is. The account deficit or net borrowing is government spending minus your taxes plus your private investment minus your private savings. So your current account surplus means there's an excess of exports over imports. Now the nation becomes a lender to the rest of the world. So that's a key thing I want you to take away from this slide. A current account surplus, if you have a surplus, you're going to be a lender. You have more funds available, more things that you can offer to the rest of the world. If you're a current account deficit, this means you have excess imports over exports. Nations become a borrower from the rest of the world. So here in the United States, we do borrow a lot of money from other countries as well as other countries borrowing from us. So again, just make sure you remember that. The key thing, if you have a deficit, you borrow. If you have a surplus, you lend. All right, so the impact of capital flows on the current account. So capital and financial flows can initiate changes in the current account. So we kind of talked about this. It'll show a huge inflow, which is good for the economy. So that's why we can afford to have so much importing. Here, we're just talking about when foreigners start purchasing more of our assets when they're purchasing, or then we are purchasing of theirs. So this is just talking about our currency exchange when our dollar becomes weaker. So U.S. goods become more expensive to foreigners, declining exports. So in this case, if U.S. goods become more expensive to foreigners, that means our value has increased. Our dollar value has increased. If our dollar value increases, we can import much more because we can buy more with our dollar. But our exporting is going to decrease because less people want to purchase our products because it's more expensive. All right, so President Trump, is Trump's trade doctrine misguided? So he wants to revise NAFTA. So this was in 2019. Again, 2020, they already talked about the U.S., Canada, Mexico agreement. It's a little different. That was talked about in the last chapter. Now he wants it revised, and he wants trade deficits. He wants to reduce trade deficits with Canada and Mexico. So basically, he wants to increase his exports, decrease his imports, become less reliant on these other countries. And the main reason, if we reduce these deficits, he wants to trade with the rest of the world as well, and not just with our neighboring countries. If we can get it from a country cheaper, that's what he's trying to do, trying to get the best deal, quote unquote. All right, so here we have an example. So this is a global production and manufacturing cost of the iPhone. So of the $179.02, the wholesale cost of an iPhone in 2009, components came from different countries to be assembled in China. So the breakdown is as follows. We have Japan, Germany, South Korea, United States, China, and we have a couple other countries as other. So these are the manufacturing costs, including labor and components. So in US dollars, the labor and components is the most from Japan, which is $60. So the percentage of manufacturing cost is 33.9. China does does minimal in terms of this production process, ranging from 3.6%. All right, so is a current account deficit a problem? So current account deficit arises because domestic economy spend more than it produces. Now, it's not bad. So here in the United States, we do import much more. That doesn't mean that we're worse off. Now, it could get to an issue if our number keeps increasing and we don't have anything to address it. So excess of demand is met by a net inflow of foreign goods and services, leading to a deficit. Basically, we have such a huge demand. We're a huge population. A lot of people a lot of people demand certain products, and we import a lot of products because consumer choice. Now, it's not necessarily a problem. So our foreign capital inflows augment domestic capital sources and keep domestic interest rates lower than would be otherwise. So again, we can afford to do this because of our capital and financial accounts. Now, the benefit of the deficit is the ability to spend more than we produce. Now, the cost is debt service that must be paid on borrowing. So that's the biggest issue. We have to pay back these loans, these securities, these bonds when they mature. And in order to get that money, you have to have that money. So in that case, we usually end up borrowing. Now, is it good or bad for a country to incur debt? Now, this depends on whether the deficit used to finance more consumption or more investment. So if it's used for investment, the burden is slight. So if we use this money to reinvest into our economy or to infrastructure, whatever it may be, it'll help. If it's used for consumption, there's going to be no boost to future productivity, and future consumption may be reduced. So if you use it for investment, it should be for the burden isn't as bad because you're going to be producing more. It's going to help you in the long run. If you're just using it for consumption, if you're just borrowing to help increase consumption, it's not going to boost your future potential or your productivity. It's just going to be helping you in the short run, again, depending on what you value or what your country values. So in 1980, the U.S. savings decreased. U.S. used foreign borrowing to increase current consumption. And in 1990, deficit driven by increase in domestic investment made possible by foreign lending. So again, in different time periods, we've borrowed for different reasons. Now, business cycles, economic growth, and current account. So we have a rapid growth of production and employment associated with growing trade and current account deficits. So basically, again, trade is good. Yes, we are at a deficit, but we still are creating jobs in our leading exporting industries. Now, the slow output employment growth associated with growing surpluses. During a recession, saving and investment tend to fall, current account balance tend to rise, and trade balance improves. So again, as of right now, economists are projecting a recession, and because of this, people are spending less, we're trading less with other countries, we're implementing more protectionist policies. That's usually what happens. And our trade balance improves because we're importing much less and we're exporting much less. So overall, we're getting closer to our zero value. And saving and investment tend to fall because people have less money. They're not looking to expand their business. Now, the way we fight this is monetary or fiscal policies, where if you think of your ASAD model, you want to fix the gap that we have, whether it be recessionary or inflationary, in order to encourage investment. So an example in modern day would be the stimulus package that's being signed to help small businesses. So they want to increase investment, they want to increase their production. The stimulus check, that's an example of increasing consumption. So again, anything to push us out of this. Now, the opposite happens in periods of boom or inflationary periods. Okay, so that's going to be all of what we talk about today. So the rest of the slides are basically just looking at what the United States is, its history. So as a debtor, basically we owe money. So the U.S. is a net debtor. Balance of international indebtedness breaks down international investment holding into several categories. So the rest is just definition based. I'll let you guys finish off the rest. But if you guys have any questions, drop a comment. Make sure to email me, show up to the Zoom sessions. This stuff will be covered on your quiz this week. other assignments in the near future, and then also your final. So if you guys have any other questions, please let me know. Other than that, I hope you guys have a good day and are staying healthy, and I hope this is helping. Thank you guys. I will see you again soon.